Hi, I'm your host, Bob Powell. We're proud to welcome you to the Exceptional Advisor podcast series brought to you by the Investments and Wealth Institute. This series aims to help you to better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences. My guest today is Herman Brodie. Herman is the founding director of Prospecta Limited. He's a specialist in behavioral economics, an accomplished speaker, and a trainer of decision makers. Herman is also the author of The Trust Mandate, the behavioral science behind how asset managers really win and keep clients. He also co-wrote and teaches the professional investment course, A Practical History of Financial Markets. So welcome to the podcast, Herman.
Hi, thank you. Good to be here.
It's a pleasure to have you. Now, before we get started, for the benefit of our listeners who may not be familiar with you and your work, do you mind giving us an overview?
Sure. So what myself and my firm, we specialize is in the behavioral sciences. Now, my part of it is concerning clients in the financial services sector. So personally, I'm most interested in the way that the behavioral sciences intersect with the work that's done by financial service providers. And these are financial advisors, wealth managers, fund managers, bankers, brokers, and all kinds of financial service providers out there. So we're looking to bring the best of the science in a practical and impactful form for those client bases.
So you've written a book. It's been quite popular, Trust Mandate. We're going to have you walk us through some of the key takeaways and perhaps some of the actionable advice that our members would benefit from.
Yeah, well, the Trust Mandate, this sprung from a conversation I had with in fact, two of my clients, who essentially both were asking the same thing. Why does the client, choose one fund manager over another, or one wealth manager over another, or one financial advisor over another? And at the time, I'd been in this business about 20 years, and I was a little bit embarrassed because I'd never really thought seriously about it. I'd made some assumptions, as we probably all do, namely that the clients would go to the best, and the best being the ones who had the clearest demonstrable performance. So the ones who had, the shiniest awards, the best track records, the best education and experience, and so on. And so we started to look into the research to see whether this was genuinely the case. And we discovered that, in fact, it couldn't be further from the truth. In fact, we looked at some quite interesting data coming from an organization called Chestnut Advisory. And what they discovered is that the best do not necessarily get all of the clients. So the fund managers they were looking at specifically, they discovered that they made a separation between the managers who had the best performance and those who were the best at essentially gathering assets, those who were able to accumulate the most assets over a certain time period. And what they discovered is that the best who were best at gathering assets actually gathered 3 times as much as the best performers. And it's worse, the same thing applied when they were looking at those who lost assets over the period. These were not the same firms who had the worst performance. In fact, some of the firms who had the worst performance actually saw inflows. So there was a big gap between the winners and the losers, and it had nothing to do with the best performance. And so we started to bring some psychologists into the research team at this point, and they simply just rolled their eyes and said, well, what did you expect? He said, what happens is when we choose somebody to whom we are going to be vulnerable, so somebody to whom we are going to be at risk, we invariably make 2 judgments about them. The first judgment that we make is about that person's intentions towards us. Does this person have good intentions towards us? Do they have benevolent intentions? Do they have my back? Are they going to take care of me? And then they make a second judgment about the ability of that person to act on those intentions. And when you have this backdrop of risk, well, then basically those two judgments combine. And this is what we call trust. And so this is the pure definition of trust. Now, of those two judgments, that one about the intentions of the other is not only the first that's made, it's the more important of the two. And so unless you can get over that hurdle, your abilities don't really matter. I think it was Roosevelt who said, nobody cares how much you know until they know how much you care. And this is exactly what the research in the social sciences discovered over the last 15, 20 years, that we make this judgment about somebody else's intentions towards us. And you can imagine this is, in fact, it's quite logical. Although we like to think that, our performance is everything, the truth is, it doesn't matter how smart you are. The client wants to know first, how are you going to use those smarts? I mean, if you're going to use them against me, well, those smarts are absolutely no use to me whatsoever, are they? It's your cleverness and your resourcefulness and your intelligence and is only useful if it's working for me and not against me. It's somebody I'd rather have somebody who's dumb rather than somebody who's smart if they're working against me or if they're on the other side. And so those are the two judgments that are being made. Now, what is crucial in the financial services industry is that, well, we're not very good at showing our benevolent intentions. When we try to compete in the marketplace, invariably we tend to do it based on our competence, our performance, our track records, and so on. And so we're very good at giving clients information they need to be able to evaluate our competence. But we are very hesitant to give them the information they need to demonstrate our benevolent intentions towards them, although this is the most important judgment that's made and the first one. And so what we've done in the book is to lay out the research and the evidence to show that this is really what's taking place, and really to call out the financial services industry for this very glaring shortcoming, namely that they're not spending that much time on delivering their benevolent intentions. Now, it's not to say they don't have them. I do believe they do. I believe that financial advisors genuinely do have their clients' best interests at heart. The problem is they're very shy about sharing this. And so what the book does is to call them out on this and show them the ways that they can act in such a way that they can create and to build these high trust relationships over time.
So I guess two questions come to mind as I think about the actionable advice. In our audience, our listener today, we will have fund managers who are trying to attract investment advisors to use their funds. And we have investment advisors who are trying to attract retail clients to use them as their provider of investment advice. When you think about how a fund manager can demonstrate benevolent intentions, or the investment advisor can demonstrate benevolent intentions to their client, is it the same technique, just different constituents using it?
Yeah, it's essentially the same technique, especially if you're all in the US, for example. It's likely, because of the cultural similarities between individuals, is that the signals that people are sensitive to as a demonstration of benevolent intentions are the same. So you might see some big differences if you're trying to win trust in, say, Japan relative to the US. But within the US, the signals that we tend to be receptive to in terms of indicators of benevolent intentions tend to be very similar. So essentially, you're doing the same work, yes.
So walk us through the signals then, maybe?
Well, the book is absolutely full of them, but there are a couple of them that I definitely want to share, because basically the rest is fine tuning. There are a couple of things you're going to have to do. Otherwise, you're never, ever going to have any high trust relationships. Never. The first thing you have to do is to trust the client. Trust the client. Now, that means to trust the client, you must have a perception of them as having benevolent intentions towards you. And you must perceive them as being competent as well. So you must have those two judgments. Now, the thing is that those judgments that you make, they are not the real traits of that client. It's the same way that the judgments the clients make about you are not your genuine traits. However, it is their perception of you, and those perceptions are real, and they give rise to genuine emotions and genuine behaviors. And so, because they only exist in our heads, we can change them. So let's say that, oh, you don't think your client is very nice because the client's actually quite obnoxious. That's just your perception. The thing is that even somebody you don't think is actually very nice, they certainly have some traits that you like. Everybody has at least some traits that you like. So he's obnoxious, but he always shows up on time to our appointments, and that I appreciate. He's always very, very well prepared. He remembers the name of my family members, and all of these things that you actually quite like. So what you have to do is you focus on those things. You have to go there. You have to comment on those things that you like. I mean, it's not about flattery. It's about adopting the mindset that the client obviously has, adopting the priorities that the client obviously prioritizes. And as a result, you can start to perceive that person as somebody that you like, as friendly. Well, let's say you say, well, the client is not particularly smart. And what you mean is the client is not smart about investing or smart about risk management. But certainly there are some things where the client is smart, perhaps even smarter than you. So let's say the client knows all about the latest technologies, or the client knows many foreign languages. Go there. Start the conversation there. Start the conversation in the place where the client is smart. Again, it's not flattery. It's about adopting the priorities that the client obviously has. And as a result, you can start to perceive the client as smart. And those two judgments come together, you're able to trust the client. Now, once you're able to trust the client, then the client will likely, well, he's more likely to reciprocate your obvious trust in them with gestures of trust on their own. So the first thing is to trust the client. The second thing is you must be ready to be vulnerable to the client. Now, no high trust relationship ever, whether this is in the personal domain or in the private domain, has ever been created without somebody being willing to be vulnerable to the other. And that means you need to be vulnerable. Now, this could be in a personal aspect, in the sense that you, early in the relationship, you reveal something about yourself. Something personal. I mean, nothing too damning or anything like that, but something perhaps even mildly embarrassing. Not something we want to scream from the rooftops, Bob, but something I don't mind sharing, just between you and me. Revealing something early in the relationship illustrates that the other person has a trusted position in your perspective. And that also gives rise to a willingness for the other to reciprocate. And we can also be vulnerable in our commercial relationships as well. If I give you the opportunity to, let's say I'm providing services, but I don't charge you for it, or I've not charged you yet, and you have the possibility to cancel at any time without any fees. If I give you that opportunity, first thing, you can't ignore it. You're very, very aware of it, that, oh, I could walk away and wouldn't have to pay anything for everything this person has done for me so far. So you definitely will not ignore it. And the second thing is, it's very difficult to attribute this to anything other than trust in that other person. And people like to be trusted. Now, of course, if you do that all the time, from time to time, you will experience some betrayal. Some people will take advantage of you. But you'll find that even those people, they tend to come back, because people like to be trusted. They like to be in relationships where they are trusted. And so even those who experience betrayal, you will find that those clients will come back. So it's important to be vulnerable. So on both of those things, you will never get a high trust relationship unless you're ready to do those things. Now, I'm sure many advisors are doing them already. And if they look back on some of their past relationships, how they emerged and how they got started and how they were built, they will be able to identify, where those things actually take place. But having a clear framework to understand how those high trust relationships were established is incredibly useful, especially if you want to share your secrets basically with somebody else.
I think in your book you refer to something being as someone having warm confidence. Is that a term that we should know about?
That's exactly right. So in the literature, they talk about these dual judgments as warmth and competence. And I use the same in the book because that's the way that it's referred to in the literature, and it's very useful then for the reader. But when I say warmth, this is a word which is used very commonly in everyday language, and we start to think it's related to a personality or charm, but it has got nothing to do with charm. It just has to do with your orientation towards somebody else, towards the other, and not towards oneself. So it's to do with, where are my intentions? Am I going to put the intentions of the other ahead of my own? And that, I think, is more accurately described as benevolence, rather than if I say benevolence, everybody understands what that means. But in the literature, it's called warmth. But I usually, when I talk about this in my presentations or so, I more commonly talk about benevolence and competence for that reason.
Yeah. So it seems to me that if trust is the end game, right, and the outcome of trust is perhaps higher client retention, expansion of services with clients, referrals, share of wallet, share of services, is it trust in fact the end game then? Is that the trust and competence perhaps?
Yes. So the benevolence and competence gives you this trust. And the gains, this is actually a win-win situation. It's not all about the advisor here. So yes, you get those things. You get better client retention. You get to win the client in the first place because trust can be established literally from the very first meeting. You get to be trusted with higher value business. You get fewer discussions about fees. This is what the data reveals. But also for the client, it's incredibly reassuring to be in a high trust relationship. And the consequence is that clients who trust their advisors hold higher betas in their portfolios than clients that don't, and durably, so over the long term. So a client, obviously, who is able to stand a higher beta without any sleepless nights over the long run is going to earn higher returns. And of course, they're also less likely to jump and waste, time and resources jumping from one manager to another manager or from one advisor to another advisor, when most of the time that doesn't bring them any advantage, just costs. So this is actually a genuine win-win situation.
Are you enjoying today's podcast? Then consider attending ACE Academy, the Institute's flagship conference. ACE Academy has assembled iconic leaders with innovative ideas focused on embracing transformation. You'll experience Ivy League quality speakers who offer real-world strategies, allowing you to provide meaningful advice for your clients. Join us May 15th through 18th in Nashville or on demand starting May 25th. Visit www.investmentsandwealth.org to learn more.
I think also in the book you talk about the notion, or you have talked about the notion of ETFs and robos gaining market share, but not necessarily having the client's best interests at heart. Talk a bit about that, why that phenomenon is occurring.
Yeah. Well, the thing is, where this emerged is essentially after the global financial crisis. And the perceptions of many clients, they changed enormously over the course of that crisis. So in the financial services industry, these professionals were anyway, before the crisis, perceived as competent. But they were not perceived as particularly benevolent, not perceived as particularly warm. After the crisis, and the clients saw some, very high profile explosions and all these supposed professionals going broke, holding, huge stock holdings in the firms that went under and they were supposed to be managing. There's all that. I'm not even sure they're competent any longer. So they suffered in this loss of competence after the global financial crisis. And there we started to see the rise of the robo-advisor, because the robo-advice is considered to be at least competent. It's been designed that way. It's been programmed to act in an efficient manner. Now, a machine can never be perceived as warm, but in the domain of the cold, the lukewarm is king. So basically, compared to the human manager, at least the machine is not working against me. It's not really working for me, but it's not working against me either. And that was actually a crucial point. But the good news for the human advisor is that a human being can always, on the benevolent scale, will always be able to outperform the machine. And this is the most important of the two judgments. So there is hope out there. One just needs to do the right things.
So speaking of the right things, I'm often reminded of, when I think about trust, I sometimes think about Bernie Madoff and how he was able to engender trust with his clients, portraying competence and perhaps even warmth maybe, and get away with it. And how do you square up what you've described with the likes of a Bernie Madoff?
Well, certainly he must have been able to convey this impression that he had the client's best interests at heart, because without it, nobody would take any significant risk, irrespective of your competence. So competence alone would never have been able to put him in that position. So if there is no risk or very little risk, it's the warmth judgment is not necessary. Just show me some good number. You want to give some money, you're going to manage a developed market equity index fund for me. Yeah, just show me some good performance that you know how to construct a portfolio, and show me some low prices. That's fine. I don't need to know that you have benevolent intentions towards me. But if I want you to manage an emerging market high yield bond fund, then I'm running into some risks here. And there I need to know that you have my best interests at heart. I need to be confident that when I'm not looking, that you are still acting in my best interests. So to take big risks, there's no way this is going to be possible unless you have this benevolent judgment. But if there is no risk or very, very low risks, it's just sufficient to be competent. And there are some financial service providers out there who are just competent, but you know who I'm talking about. And they can get a little bit of everybody's money. Now, a little bit of everybody's money is still a hell of a lot of money, but they can, and that's good enough for them. But if they're going to manage the farm, there is no way you're going to get there unless you have achieved this perception of benevolence among your clients.
So anything that we missed with respect to the trust mandate, or anything that bears reemphasizing before we move on to behavioral finance concepts?
I mean, I'll tell you, do you know what the most trusted profession is out there? Do you have any idea who this might be? This gives you a good clue as to how this really works. The most trusted profession, pretty much everywhere in the world where they ask this question, this profession is always in the top three, probably usually in the top
I'm not
two.
sure. Nursing?
Not too bad. It's firefighter. Firefighter.
Always acting in my best interest.
Now you can imagine. Now you see exactly what's going on. Number one, of course, if we need the services of a firefighter, we are exposed to risk. And also people believe that the credentials and the training for becoming a firefighter are very rigorous indeed, so they're perceived as competent. But the most important thing is they are perceived as benevolent. These are the kinds of people who are going to rush into a burning building to save people. So they put themselves in harm's way to protect others from harm. And this is precisely the definition of benevolence. So what you have to try and be is like the firefighter. So there you go.
That's great advice. So I want to turn our attention to behavioral finance concepts that advisors should know about. And Also with a particular emphasis on what they may need to know with respect to their retired or pre-retired clients, if there are different concepts that they need to think about.
Yeah. Well, of course, behavioral finance concepts, they don't only apply to, this is the first thing I like to say, don't only apply to the clients. So as human beings, both the advisor and the client are prone to all of the behavioral tendencies that have been well documented in the literature. There is a tendency in the industry for us to think, well, my problems are sorted now. I just need to manage the biases of my clients. But in fact, this is not really the case. I mean, knowing about behavioral finance and reading about this does not necessarily make you a better decision maker. Otherwise, I'd probably be one of the best decision makers in the world. And I can assure you that this is definitely not the case. So what we have to do in every case is, both for advisors as well as for clients, is to make sure that we have a rigorous process, that we discuss those processes, and that we have the discipline to adhere to them. And it's important both for the advisor as well as for the client. But a couple of years ago, we did some research looking at the relationship between the behavioral sciences and the retirement decision. And some of the questions that future retirees may well ask their advisors, like, when should I retire? Will I be happy in retirement? And things like this. And one of the others, what was the first one again? Because there are other things which are also taking place when we get older, is that there are some changes in our cognitive ability. Now, one of the most interesting ones was, and probably one of the most frequently the ones that were answered, is, will I be happy in retirement? And we went through all of the data looking at this happiness rating over the entire life cycle. And what we discovered was that those people who are most likely to describe themselves as happy in retirement were exactly the same ones who said they were happy in work. Which means if they are happy now, then they will be happy in retirement as well. And so that answer was actually quite simple. When it came to the issue of when one should retire, it seemed that people were very much influenced by the retirement age that's essentially set as a reference point by Social Security. So that seems to be a very, very salient reference point for people. And it's the same when we looked at the data for the UK, where I am. It was very much influenced. The retirement age was 65. People who retire at 63, it's talked about, oh, they're retiring early. But I mean, early for whom? Early relative to what? And in fact, they're taking a very salient reference point and use this as a guiding point for retirement decisions, although this was not necessarily pertinent for the retirement decision. And the data from the US revealed exactly the same thing. And there was a real life experiment when they shifted the retirement age. The legislation moved to shift retirement ages progressively. They discovered that there was always a peak in exits from the work market that corresponded to the progressive shifts in the retirement age. So a lot of people, at least those people who had the choice, were nevertheless using that as a very salient reference point, which is obviously something which would have been predicted from behavioral science research. We looked at things like annuities, which obviously is a very good way of giving a much more objective measure of when one should retire. When can you afford to retire? And you can use the annuities as a useful tool for guiding that retirement date when it's convenient to retire. And we looked at things like, what made retirees unhappy in retirement. And there was health. And the second one was not running out of money, but the fear of running out of money. And then that was pretty much it. The rest was so far, far below on the list that it didn't really matter. So if you can sort out preparations for healthcare, and you can sort out a situation where they don't need to worry about whether or not they will run out of money, you basically got the two most important bases covered. And once again, annuities played an important role in that ability as well.
So you mentioned one of the questions being, will I be happy in retirement? And if you were happy in work, you'll be happy in retirement. But for folks who maybe were unhappy at work, do you see that there's a role for the advisor to play in helping that unhappy worker become a happy retiree, either by finding purpose or a different kind of work or a different place to live? Or is there a role or not for the advisor in that regard?
Well, most of that judgment that is actually genetically determined. So we have it pretty much over our entire lives. So for at least 2/3 of us, our life satisfaction rating does not change over our entire life. This is pretty bad news for those who chose their parents badly, you know. Yeah, we don't change. If you're happy, then this seems to be a genetic disposition, and 2/3 of us, that's not going to change. Of the remaining third who are able to change durably their life satisfaction rating, most of them, 3/4 of them, change it for the worse, not for the better. So something happened in their life and it changed durably their life satisfaction rating. So the hope of being able to change somebody's life satisfaction rating at all, and then to change it for the better, this is an incredibly ambitious goal. I'm not saying one should not try, but it's an incredibly ambitious goal. I think a more realistic goal, and certainly one which is which I consider to be the role of the advisor, is to make sure that there is nothing happens that will make them more miserable from their finance perspective, and healthcare, having their healthcare covered and so on.
So as you think about maybe some of the key concepts that advisors might need to know about, are retirees perhaps less prone to overconfidence and more prone to recency bias, for instance, or do you see anything of that sort?
Well, the tendency there is just equally distributed across the entire population. So most of us are prone to the recency bias. Most of us are prone to being overconfident. And of course, then the average distribution of advisor clients are going to exhibit those traits. So learning about them is certainly useful, because you will encounter them.
Right. All right. I know we're running up against our time today. Anything that we missed or anything that bears reemphasizing before we wrap up?
On retirement, well, certainly one should think about the cognitive decline, of course, which kicks in starting at an age around 55 or so. And the important thing is that most people don't want to accept that they are suffering from cognitive decline, especially men, which means that after a certain time, we are going to start to do things which require that we address that problem of cognitive decline, which means we need to have more time to make our decisions. We must not rely too heavily on memory. We must have all of the information in front of us. And this requires them some additional time to think it over, and that helps to compensate. But beyond a certain age, especially when you're going beyond 75, it starts to be a lot more pronounced, this cognitive decline, which means you need to name somebody who's going to help you on those decisions. And so to put that information, that evidence in front of clients is very, very useful. It's not you, it's everybody once we start to get a certain age. And it's a good idea if you can name somebody who's going to accompany you through that decision-making process.
So it strikes me too that financial advisor, investment advisor also needs to have some training around cognitive decline. So in order to, one, either detect it or prepare their practice and their clients for this eventuality.
Absolutely. And of course, the advisor's own cognitive decline should not be neglected. It's definitely, this is an area that requires a good deal of attention, yes. And there are things that we can do.
No, that's helpful to learn. Herman, this has been a wonderful chance to catch up, and I'm sure our listeners will benefit greatly from listening to the podcast. So thank you.
You're very welcome. It's good to talk to you.
Thank you for listening to the Exceptional Advisor podcast brought to you by the Investments in Wealth Institute. If you've enjoyed this podcast, please subscribe through iTunes, Spotify, or our website at www.investmentsinwealth.org/podcast to get the latest episodes of our Exceptional Advisor podcast series. For additional resources, updates on events, and exclusive membership deals, visit www.investmentsinwealth.org.